Where 30 years ago you saw not much villages, maybe large, extremely large villages, but you saw bicycles, and you now see hundreds of buildings. You see the cranes operating. You see, I mean, it is incredible the transformation that has happened to a country where for hundreds of years nothing happened. The system now is unleashing their potential, and just like our system has unleashed our potential in this country. I mean, for millennia, people went nowhere in the world. I mean, your great-great-great-great-grandchild was going to live the same as you did for many, many centuries. Our country in the last couple hundred years has just unleashed human potential like nothing we've ever seen. The same thing is now happening in China.
Chinese stock market have been a hot topic in recent times. There are people who are afraid of it, and there are some recommending it as an investment opportunity to the masses. In today's video, let's take a look at Warren Buffett and his investments in China. Before that, please hit the like and subscribe button to help the channel grow, and comment down what topic you want to be discussed in this channel. The first investment we are going to talk about is BYD, the EV car maker which famously invested by both Buffett and Munger. Berkshire Hathaway paid around $232 million for a roughly 10% stake in BYD in late 2008. Berkshire initially attempted to purchase 25% of the company, but Wang, the founder of BYD, refused to sell more than 10% of BYD's stock to Warren Buffett's investment firm. It turned out to be money well spent. As the EV market in China has exploded, BYD has emerged as a major player in the world's largest car market, selling more than 130,000 electric vehicles last year as it competes for market share with rival EV makers such as Wuling, NIO, and, of course, Tesla.
Like they hope it will give them a clear advantage. But battery technology is a evolving and tough game, and my partner Charlie particularly thinks that we've got the right fellow to make the breakthroughs in that area. But it isn't like you get it tomorrow or the next day. And you know, there are a lot of smart people working on battery technology, and you know, in the end, what I hope is the world gets a great answer on it very quickly. And if it says made in Japan, made in China, made in the United States, the important thing for humanity is that we get great battery technology. Now, like I say, Wang Fu is an amazing guy. I'm impressed with him.
The gentleman who runs
BYD,
right.
and my friend Charlie, who knows a lot more about batteries than I do, thinks that this guy is the second coming, more or less. So we'll see what happens on that. It's not easy. I mean, when you're dealing with batteries, you know, the weight, the cost, there are plenty of problems involved. But I will bet significant progress is made by BYD, but there may be more significant progress made by somebody else in the next few years.
Tony in San Diego writes in and says that BYD's lost more than 60% from its peak in 2010. Do you consider buying more shares because of the current discount?
Yeah, well.
As the value of Berkshire Hathaway's investment in BYD has grown, Berkshire Hathaway's stake in the company had grown to around $1.6 billion by late 2018, 10 years after the $232 million investment was made. Since then, that figure has risen exponentially in tandem with the rapid expansion of the Chinese EV market, and a remarkable fourfold increase in BYD's Hong Kong traded shares last year. Berkshire Hathaway's 8.2% stake in the automaker was valued at $5.9 billion during the end of 2020. This means that BYD was Berkshire's 8th largest holding by market value at the end of last year, making it a more valuable investment for him than his stake in General Motors. As of December 31, Berkshire's 3.7% stake in GM was valued at $2.2 billion. Now for our next investment, let's take a look back, where Buffett purchased PetroChina's stock for $400 million in late 2000s. This was the conglomerate's first purchase of a Chinese stock, making it a significant owner of PetroChina at the time. Warren Buffett had made a relatively simple calculation where he could see that this company made $12 billion per year and produced 3% of the world's oil.
PetroChina itself is not a complicated or opaque company. You know, the country, you know, has obviously different characteristics in many respects than the United States, but the company is very similar to very similar to big oil companies in the world. PetroChina may have been it may have been the fourth most profitable oil company in the world last year. I may be wrong on that, but they produce 80 or 85% as much crude daily as Exxon does, as I remember, and it's a big company, and it's not complicated. I mean, obviously a company with 500,000 employees and all of that, but a big integrated oil company. It's fairly easy to get your mind around the economic characteristics that will exist in the business. And in terms of being opaque, actually their annual report may well tell you more about that business, than you will find from reading the reports of other oil giants. And they do one thing that I particularly like, which other oil companies don't, at least to my knowledge, is that they tell you they will pay out X percent. I think it's 45% of their earnings, absent some change in policy. But I like the idea of knowing in a big enterprise like that 45% of what they earn is going to come to Berkshire, and the remainder will be plowed back. It was bought not because it was in China. It was bought simply because it was very cheap in relation to earnings, in relation to reserves, in relation to daily oil production, in relation to refining capacity, whatever metric you want to use. It was far cheaper than Exxon or BP or Shell or companies like that. Now you can say it should be cheaper because you don't know what will happen with it 90% owned by the government of China. And that's obviously a factor that you stick in valuation. But I did not think that was a factor that accounted for the huge differential in the price at which it could be bought. And so far it looks okay on that basis. We aren't there because it's China, but we're not avoiding it because it's China either. We stick in a fairly appropriate number. But if you read the annual report of PetroChina, I think that you will have as good an understanding of the company would if you read the annual report of any of the other big oil majors. And then you would factor in your own thinking about whether there could be some huge disruption in Chinese-American relationships or something of the sort, where you would lose for reasons other than what happened in terms of world oil prices and that sort of thing. But we're happy with it. And Charlie?
I've got nothing to add. If a thing is cheap enough, obviously you can afford a little more country risk or regulatory risk or whatever. This is not complicated.
Yeah, Yukos, as you know, is a very big Russian oil company, and in evaluating Russia versus China in terms of country risk, you can make your own judgments. But in our view, something like PetroChina was both cheaper and had less risk. But other people might see that differently. We'll go to number 12.
This is a classic heads I win, tails I don't lose much bet. PetroChina was extremely cheap, and this valuation compensated for some of the uncertainty Buffett would have to face if he had purchased a foreign company. This is an example of Benjamin Graham's margin of safety in action. Buffett purchased the stock at a rock-bottom price, leaving plenty of room for error. Even if he thought the business was worth 9 times earnings and was 50% off, he would still have made a 50% profit on the purchase price, excluding any income received. I can't think of a better way to summarize Buffett's investment. He may not have understood the complexities of China's financial and political systems at the time, but the margin of safety available on the shares was so large that it rewarded him and Berkshire's shareholders for the risk taken. This is something investors should keep in mind when investing abroad or in sectors with which they are unfamiliar in. A large margin of safety can compensate for a lack of knowledge, but it should never be used as a substitute. The simplest way to reduce risk is to conduct additional research. Even if you have done your homework, you cannot account for the unknowns. This is where the margin of safety comes into play. And for Buffett, it have been very profitable over the years. From this, we can conclude that Buffett's investment in BYD and PetroChina has performed really well. It doesn't mean majority of the Chinese stock can be considered as an investment opportunity. We must be aware of the risk involved when investing in China. especially during this time, where there is a risk of war and a huge crackdown happening in China, bringing the entire Chinese stock market sector down. With this, let's end the video. Business Wisdom, signing out.